अशोक जी आपको म्यूट करना पड़ेगा, बैकग्राउंड से नॉइज आ रहा है। अजीत जी आपको भी म्यूट करना पड़ेगा।
Hope my screen is visible and my voice is also audible to everyone. Yeah, good morning, everyone. And today I'm going to talk about three standards, three small standards, but very important standard, which is 105 non-current assets for held for sale and discontinued operations. Then I will be covering Ind AS 23, which is on borrowing cost. And then I will be covering Ind AS 41, which is one of the unique accounting standard on agriculture. So three standards I will be discussing in the next 3 hours, which is Ind AS 105, Ind AS 23, and Ind AS 41. And just to reiterate, these are the query sessions. I need to say, of course, I'll touch upon the concept. And today, I'll discuss and I'll solve some questions also, okay, on Ind AS 105, 23, and 41 to rush down with all the concepts with the help of the questions. Okay. So the first standard is Ind AS 105, friends. And I hope this will be okay for each one of you that we will discuss some concept and we will also discuss some questions and the detailed questions, the complex questions, and with the help of the question, we will discuss those concepts as well. Okay. So, friends, first of all, I will be covering Ind AS. I am covering Ind AS 105, which is non-current assets held for sale and discontinued operations. This standard I have taken in the month of November 2023. It must be there on the learning portal, and you guys must have been covered this standard in the learning portal. Okay. So, non-current asset held for sale and discontinued operations. First of all, let me set the context of this standard. This standard talks about non-current asset held for sale and discontinued operations. So what is meant by non-current asset held for sale and what is going to cover in this standard? Let's say if DLF is selling flats, right? So flat is a non-current asset or flat is a current asset? If I talk about the nature of the flat, generally it is a property, plant and equipment. But for DLF, this flat is like an inventory, right? Why? Because DLF is selling these flats in the ordinary course of business. So for DLF, these are the inventory. Likewise for Maruti, Maruti is selling cars. For Maruti, whether selling of car is whether these cars are inventory or these cars are PP. Generally, by the nature of this item, cars are PP. But for Maruti, since Maruti is selling these cars in the ordinary course of business, so for Maruti, these are the inventory, these are the current assets. Sir, then what is going to cover in non-current assets held for sale and discontinued operation? What is going to cover in Ind AS 105? So let's say Maruti is into the manufacturing and selling of cars, right? So Maruti has sold 5 Ciaz cars to the TCS, to the top executive of TCS, Tata Consultancy Services. So Tata Consultancy Services has purchased 5 Maruti Ciaz cars for their top employees. The top employees didn't like those cars and they said, we need Mercedes. So now Tata Consultancy Services wants to sell these cars. Question number one, what is the nature or classification of these cars in the balance sheet of TCS? In the balance sheet of TCS, these cars will be property, plant, and equipment. For Maruti, it is inventory. For TCS, it is a property, plant, and equipment. But the moment TCS wants to sell these cars, now it becomes what? Now it becomes inventory. Answer is no. Why it is not an inventory? Because the ordinary course of business of TCS is not to trade in cars. The TCS is into software, into applications, right? So the moment TCS wants to sell these cars and some criteria of Ind AS 105 held for sale criteria will met right? TCS will classify these cars into non-current asset held for sale separately in the balance sheet. Separately in the balance sheet. So, friends, the basic differentiation between inventory and non-current asset held for sale is inventory are the asset which is held for sale in the ordinary course of business. But non-current asset held for sale are those non-current asset, not current asset, those non-current assets, right? Which will be classified as a held for sale if some criteria will met. Some criteria which is given under this standard will met, right? So this is the basic difference between inventory and non-current asset held for sale. Some criteria should be met, and in to be covered under this particular standard, that has to be non-current asset. Inventory by nature is a current asset, right? For example, Boeing, Airbus, they are manufacturing and selling aircraft. So these aircraft are inventory for Airbus or Boeing, and these are the current assets for Airbus and Boeing. But let's say if Reliance is buying one of the aircraft, for Reliance it is a property, plant and equipment. When Reliance wants to sell that aircraft, then it will become non-current asset held for sale under Ind AS 105, provided some held for sale criteria should met, right? So I believe the context has been set. Now I will quickly discuss what is the coverage of this standard. This standard covers three aspects. Number one, this standard covers individual asset held for sale. And let me give you an example. With the help of example, we will discuss that what three items are covered under this standard. Number one, individual asset held for sale. And what is that? For example, let's say I have a factory in Lawrence Road area in Delhi. Okay. This Lawrence Road area is an industrial area. So I want to sell a factory. Sriya came to me and she asked, "Sir, I have heard that you want to sell a factory." I said, "Yes." So she asked me, "What all you are going to sell?" It means what is there in the factory? I told Sriya that I only want to sell my factory building. I have machinery, I have furniture fixture, I have office equipment, I have raw material, I have finished goods, but I don't want to sell all these items because I want to take these items along with me into a new factory. And I only want to sell my factory building. So what is this? Is it an individual asset held for sale or is it a group of asset held for sale? This is known as an individual asset held for sale, and this is known as a non-current asset held for sale. Then Sriya convinced me. She told, "Sir, why don't you want to sell this entire factory as a whole, as a slump sale? Right? And I'm ready to buy the factory building, the plant and machinery, the furniture and fixtures, office equipment, raw material, finished goods, softwares, licenses. I'm ready to buy that." And I told Sriya, "Sriya, I have a loan which is going on in this factory also." She told me I'm okay to assume that loan as well, that liability as well. So, friends, is it a group of asset held for sale or is it an individual asset held for sale? This will become a group of asset held for sale, and under Ind AS 105, this will be known as a non-current. This will be known as a disposal group held for sale. So the first one is individual asset held for sale, which is known as a non-current asset held for sale. The second one is a group of asset held for sale, which is known as a disposal group held for sale. The third one, the third one is discontinued operations. And what is discontinued operations? Discontinued operations means, let's say I have two factories in Delhi area. Okay. Now Shriya told me, "Sir, I don't want that you should continue your business in Delhi. I want that you should move out from this geographical area of operations so that I will have my monopoly. And for this, I will give you a good amount of premium. I am ready for that. And now I'm discontinuing my geographical area of operations. I'm discontinued my operations in Delhi, including my two plants. right? So this is known as a discontinued operation. So in this standard, we will be talking about individual asset held for sale, disposal group asset held for sale, and discontinued operations, right? So friends, for disposal group asset held for sale, for disposal group held for sale, there could be a combination of non-current asset as well as current asset, including liabilities. Okay. For an individual asset held for sale, that asset will always be a non-current asset. But for disposal group, it can be a combination of non-current asset as well as current asset. Okay. I hope it is clear to all of you. Right, Rahul? Great. Okay. So, friend, for discontinued operations, in discontinued operations, the extra presentation and disclosure requirement will be there. So now I'm moving to the just just a minute. Yes. Now I'm moving to the criteria for held for sale. What is the criteria for held for sale and what is meant by non-current asset held for sale? Non-current asset held for sale are those items where carrying amount will be principally recovered through a sale transaction, not through a continuing use. Means for every asset, there must be a future economic benefit. For example, if you purchase a machinery and it is a PPE, property, plant, and equipment, what is the future economic benefit out of that? You will use in the production, you will have the production of goods, right? And by that, you will getting the future economic benefits. You are purchasing a truck. What is the future economic benefit out of the truck? Since you are recognizing as an asset, you will use the truck for transportation of goods, right? And that is how you will arriving at future economic benefit. You are purchasing an office building, acquiring an office building. What is the future economic benefit out of that? That is for administrative purposes. You are running your office or business there, correct? So every asset has a future economic benefit. But if an asset is classified as a non-current asset held for sale or a disposal group asset held for sale or disposal group held for sale, what is the future economic benefit out of that? So standard says that in case of a non-current asset held for sale or disposal group held for sale, the future economic benefit will be recovered through a sale transaction rather than through a continuing use. It means the assets which are coming under Ind AS 105, which is a NCA HFS. In short, I'll call it as a NCA HFS, non-current asset held for sale, and DGHFS, disposal group held for sale. In short, I'll call it as a NCHFS or DGHFS. So this NCHFS or DGHFS, right? The intent of the company from the individual asset or group of asset is not to use the asset, rather to sell the asset. Okay. So the future economic benefit will be coming through a sale transaction, not through the continuing use. Now, friends, what is the held for sale criteria? Friends, there are two criteria for held for sale. ISPC plus HP. What is meant by ISPC plus HP? ISPC means Internet Service Provider Company. No. ISPC means immediate sale in present condition, available for immediate sale in present condition. And what is meant by HP? HP means highly probable. First, I'll discuss ISPC, held for immediate sale in present condition. Okay. So I'll explain this with the help of this one example. Let's say I have a 3-floor building. I have a building where 3 floors are there, and I want to sell my third floor. And I put 4 sale board on my third floor. Okay. Rahul came to me and he asked me that, sir, I have heard that you want to sell your third floor. I said, yes, Rahul, I want to sell my third floor, but I will sell my third floor only when my fourth floor construction will get over. Okay. So I said, okay. He said, okay. So now in this case, I have two questions for you. Question number one, whether the third floor is available for sale. Question number two, whether the third floor is available for immediate sale in present condition. Whether so two questions. Abrakesh, two questions are there. Question number one, whether the third floor is available for sale. Question number one. Question number 2, whether the third floor is available for immediate sale in present condition. You're right, Abrakesh. For question number 1, the answer is yes. For question number 2, the answer is no. Yes, the third floor is available for sale, but the third floor is not available for immediate sale in present condition. So, my dear friends, in the examination, if the question is asking about your application knowledge, then the question will be twisted around these concepts where it says that prima facie it is available for sale, but prima facie it is not available for immediate sale in present condition, right? So you need not to be flow with the flow. You have to carefully read the question, understand the question. Okay? If the question will say that the seller will sell the flat only when the fourth floor construction will get over, right? And there is no time period given in the question. In that case, you have to say and you have to assume that it is not available for immediate sale in present condition. Okay. In that case, Ind AS 105 accounting will not be there. In that case, PP accounting may be there. Correct? So it has to be available for immediate sale in present condition. Question number 2. Situation number 2. A seller wants to sell his factory, right? A company wants to sell his factory, and the company has put for sale board outside the factory. The company has invited, the quotations. The company has registered the listing on the 99acre.com, proptiger.com. So the company wants to sell this factory. A buyer came. The buyer asked that I have heard that you want to sell the factory and I want to buy this factory. So the seller told, I will sell the factory only when my only when my production period will get over, because I have some pending orders, right? And these pending order completion will take around 6 to 7 months. So I will be able to sell only when my production will get over, my production cycle will get over. Now the question is whether the factory is available for sale. The other question is whether the factory is available for immediate sale in present condition. So for question number 1, again, the answer is yes. For question number 2, the answer is no. It is not available for immediate sale in present condition, right? I believe now you guys have understood that it has to be available for immediate sale in present condition. Then I'm just flipping my question. The buyer said, why don't you want to sell this factory in the same condition? Whatever pending orders are there, because I want to run this factory. Whatever pending orders are there, I will fulfill those orders and I'll give you premium for these pending order as well. Whatever margin, profit margin will be there, I'll pay you. So the seller get ready. The seller said, okay, I'm ready to sell this factory in the same condition. So now, whether it is available for immediate sale in present condition, answer is yes. Now it become available for sale in present condition. Okay. Whatever condition is there, it is available for sale. And to saying that it is available for sale, is it like that it has to be instant held for sale, instant available for sale? Means, for example, if a buyer is wants to purchase a building and the seller wants to sell this building, the building is available for immediate sale. Does it mean that the seller used to throw all his belongings from the balcony and just need to vacate the building in an hour? Answer is no. Standard says that it has to be available for immediate sale in present condition, subject only to the terms that are usual and customary for sale of such asset. For example, if you have to vacate, if you have to sell a building, it will take some procedure also. You have to enter in agreement to sell, right? You have to enter into agreement to sell. You have to get the registry done. Okay. And someone has to vacate the building also. So it will take around 1 month. Okay. Or if there are tenant, then 1 month notice has to be served. So if it is like 1 month or 2 months, so it is like a usual and customary time period for sale of such asset, then it is okay, right? Then it is okay. So friends, the first condition is it has to be available for immediate sale in present condition, be it a individual non-current asset or be it a disposal group held for sale. The how will you be able to understand that it is available for immediate sale in present condition? So the intent and ability both should be there. Intent and ability means The intent has to be there and ability has to be there. Like in the first example of my third floor sale, my ability was there because I was the owner of the building. I was able to sell, but my intent was not there, right? So intent was missing, but ability was not missing. So for satisfying the criteria of available for immediate sale in present condition, the intent and ability both should be there. Second example, another example I am taking with this, you will be able to understand the meaning of intent and ability as well, very well. A company has purchased a plot of land. The neighbors has disputed that land and file a case in the High Court. The High Court has stayed. The High Court has put a stay on that land. Now, this company wants to sell this plot of land. The company wants to sell. If the buyer will come, the company will sell immediately. Now, the question number one, whether the intent is there. Of course, answer is yes. The company wants to sell. Whether ability is there, will the company be able to sell this plot? Answer is no. Why? Because there is a stay which is put by the court, and hence the ability was missing, but the intention was not missing. So in this case, the intent and ability both are not there. Means intent is there, but ability is not there, and hence it will not be qualified as available for immediate sale in present condition. You are right, Sriya, it is disputed, so no ability. So friends, the first criteria we have understood, available for immediate sale in present condition, and it shows your intent and ability to sell the asset. Now the second criteria is sale is highly probable, HP. Hindustan Petroleum nahi, highly probable, HP. The sale will be considered as highly probable when five conditions will be satisfied. Management is committed to a plan to sell the asset. Active program to locate a buyer has been started. Correct? So management is committed means it is already approved in the board meeting. Active program to locate a buyer has been started means the company has started searching the buyer. Right? So let's say Abrikes is a chartered accountant and he is the auditor of a listed company. So CFO called Abrikesh that sir, I want to classify my plant and machinery as a held for sale. So Abrikesh asked, is it available for immediate sale in present condition? He said, yes, sir. If today buyer will come, I am okay with entering into an agreement and initiating the sales formalities. He said, right. Then Abrikesh asked, is it whether the sale is highly probable? The CFO told Abrikesh, sir, what do you mean by sale is highly probable? Then Abrikesh asked some questions, whether management is committed to a plan to sell the asset. CFO told, yes, sir, we have already approved this agenda in the board meeting. Then the second question Abrikesh asked, have you started searching a buyer? Then the CFO told, yes, sir, we have got this property listed on various websites, various portals. We have also told our broker to find a buyer. We have also put this listing on the newspaper advertisement. We have also put this listing on our website. So we have already started searching a buyer. The third question Abrikesh is asked, what is the price you have quoted? Is it reasonable in relation to market value, fair value? Then the CFO told, yes, sir, we have got the valuation done and we have found that valuation is 1 crore. And we have also kept the price in relation to 1 crore only, near to 1 crore. So our asking price is 1.1 crore. And of course, if the buyer will come, there will be some sort of negotiation also. And we are okay to sell anywhere in the range of 1 crore. Then Abrikesh asked four questions. Question number four, the fourth question. Do you expect that the sale will be completed within 1 year from the date of classification as held for sale? Then the CFO told, yes, sir. We are expecting that the sale will be completed within 1 year from the date of classification as held for sale. The fifth question Abrikesh asked, is there any likelihood that you will sell your change plan? Because actually you are not selling today. It is available for immediate sale in present condition. And these criteria are meeting and hence you are classifying your property, plant and equipment, your non-current asset, as a non-current asset held for sale. But tomorrow you will say that no, 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 I don't want to sell this asset. Then CFO told, sir, you have seen that we have already started moving our operations to the new factory, right? And our production is entirely stopped in this factory. The manpower has moved, everyone has relocated. We have purchased our guest house also near to the new plant. So it is unlikely that the sale plan will change, right? So these are the five conditions. If these five conditions will be satisfied, then we can say that the sale is highly probable, right? And the sale should be expected to be qualified as a complete sale within 1 year, subject to event outside entities control, right? So even though if the sale will not complete within 1 year, if it will extend beyond 1 year, still it will be classified as a held for sale. Still it will be considered as a sale is highly probable if the extension of the period is not within the control of the entity. For example, COVID, the classic example. Due to COVID, the registries was not happening, the court was closed, right? And the sales has took more than 1 year to conclude. So in that case, it will still be continue to be classified as a held for sale, even though the period has extended beyond 1 year. Correct? Is that clear? So friends, this is the held for sale criteria. Now measurement criteria is standard says that the held for sale asset, non-current asset held for sale, or disposal group held for sale, or disposal group held for sale has to be, or disposal group asset held for sale has to be measured at carrying value, or has to be measured at carrying value or fair value less cost to sell, whichever is lower. So friends, if any asset which has become held for sale, if any asset which has become held for sale, step number one, you have to compute the carrying value of that asset as per step number one, you have to compute the carrying value of that asset as per the respective standard, as per the respective standard. Okay. Number two, number two, you have to you have to compute the fair value less cost to sell. You have to compute the fair value less cost. Whatever is lower will be considered as a value, of non-current asset held for sale. Non-current asset held for sale. So for example, the building was purchased on 1st April 2020. For example, the building was purchased on 1st April 2020. Okay. Or let's take this example only. Illustration number one. Entity ABC owns an item of property and it was stated at the following amount in the last financial statement. 31st March 2001, 12 lakh, depreciation 6 lakh, net book value 6 lakh. Okay. The asset is depreciated at an annual rate of 10%, that is 1,20,000 per annum. And this is on 20x1. The entity is closing its books of accounts on 31st March every year. During July 20x1, entity ABC decided to sell the asset, and on 1st August it meet the condition to be classified as held for sale. So friends, first of all, we have to compute the carrying value of this asset, carrying value of this property on 31st July 2001. What is the carrying value? Please tell me. The net book value on 31st March is 6 lakh. And now you have to arrive at a carrying value on 31st July. So you have to charge the depreciation for a period of 4 months. You have to charge the depreciation for a period of 4 months. April, May, June, July. If the full year depreciation is 1,20,000, what is the depreciation for 4 months? What is the depreciation for 4 months? 40,000. So what is my carrying value as per Ind AS 16 on 31st July 2001? Immediately before classification is held for sale. 5,60,000. 5,60,000 is my carrying value. Now, friends, this is my step number one. Step number two is compute fair value less cost to sell. Generally, it will be given in the question. Okay. So assuming the fair value less cost to sell is 5 lakh rupees, right? So step number one, compute carrying value as per the respective standard like PP&E. Step number two, compute fair value less cost to sell. For example, it is 5 lakh rupees. Now, whatever is lower, what is lower? Whether step number one carrying value is lower or step number two fair value less cost to sell is lower. Fair value less cost to sell is lower. So we will recognize NCA-HFS at lower value. So what is the accounting entry? NCA-HFS property account debit 5 lakh, 5 lakh rupees. 2. Property, plant and equipment property 5 lakh 60,000 rupees. The differential of 60,000 rupees will be charged to impairment loss. Right? Balancing figure. Impairment loss on change in classification 60,000 charged to P&L. Is that clear? The measurement part is clear? The measurement part is clear or not clear? Clear? So friends, now we will discuss this concept with the help of this example. A property is purchased for rupees 5 lakh on 1st April 2018. Now, with the help of this example, we will cover the entire concept of non-current asset held for sale. The useful life of the property is 20 years, zero residual value. Okay. So what is my cost? My cost is 5 lakh rupees. What is my date of purchase? 1st April 2018. The useful life is 20 years, zero residual value. The property is measured subsequently at cost model, depreciated historical cost. So this property is property, plant and equipment, right? This is Ind AS 16 item. The cost is 5 lakh. The date of purchase is 1st April 2018. Useful life of the property is 20 years. Correct? Useful life is 20 years. Now, what is my per annum depreciation? As per Ind AS 16, what is my per annum depreciation? Can anyone tell me what is my per annum depreciation? Yeah. What is my per annum depreciation? Yes, 25,000. 5 lakh divided by 20 is 25,000. So yeah, how come it is 40,000? 5 lakh divided by 20 is 25,000, correct? Sriya, do you have any doubt here? Correct. So on 30th September 2020, on 30th September 2020 means after how much of period? After 2 years and 6 months. After 2.5 years. After 2.5 years. 2 years, 6 months. It is decided that the property is to be classified as held for sale. Why? Because the classification criteria are met. It means this property has become available for immediate sale in present condition as on 30th September 2020 and the sale is highly probable. Correct? So now what to do as a first step? What to do as a first step? This property has become held for sale on 30th September 2020. That is 2.5 years after the date of purchase. Correct? And it also says that an impairment assessment on 30th September 2020 determines the recoverable value based on value in use is to be rupees 4 lakh. Right? And the recoverable value is also given on 30th September 2020 and it is 4 lakh rupees on the basis of value in use. Now, what is my step number one? My step number one is to compute carrying value as per the respective standard. Respective standard means the standard to which originally this asset belongs to. Originally, this asset belongs to Ind AS 16 property, plant and equipment. So I need to compute the carrying value of this asset. Carrying value of this asset as per PP&E standard, right? Immediately on the date of classification as held for sale. So now, what is my cost and what is the formula of carrying value? What is the formula of carrying value? Can anyone tell me? What is the formula of carrying value H per Ind AS 16 or Ind AS 38 or Ind AS 40? Carrying value is equal to cost minus accumulated depreciation minus, uppercase, is it only cost minus depreciation? Cost minus accumulated depreciation minus accumulated impairment losses. What is the formula of carrying value? Cost minus accumulated depreciation minus accumulated impairment losses. Correct? Friends, what is my cost here? It is 5 lakh. What is my accumulated depreciation till 30th September 2020? What is my accumulated depreciation? Uppercase, it is not 52,500. 25,000 for 18-19, 25,000 for 19-20, and 50%, which is for 6 months. 6 months means half year depreciation for 2021 up to 30th September 2020. So it is 62,500. So cost minus accumulated depreciation is 4,37,500, which is 5 lakh minus 62,500. Is it my carrying value? Whether 4,37,500 is my carrying value, do I need to deduce something? Yes. The formula is not only cost minus accumulated depreciation, it is cost minus accumulated depreciation minus accumulated impairment losses. You have to check your impairment assessment also, right? And standard, and the question is given you that the recoverable value is 4 lakh only. The recoverable value is rupees 4 lakh only. So recoverable value is 4 lakh and cost minus accumulated depreciation is how much? 4,37,500. It means there is an impairment loss. There is an impairment loss of 37,500 also. This is my cost. This is my accumulated depreciation. This is my impairment. And this will be my cost. This will be my carrying value as per step number 1. Compute carrying value as per respective standard immediately before classification is held for sale. Right? Is that clear? Are you guys clear on this? So when I have purchased this asset, what was the accounting entry? Property, plant and equipment account debit to bank account 5 lakh rupees. When I was charging depreciation, what is the accounting entry? Depreciation account debit to accumulated depreciation or depreciation account debit to property, plant and equipment. When I have charged impairment loss, what is the accounting entry? Impairment loss charge in P&L account debit to property, plant and equipment. Now the carrying value of the property, plant and equipment becomes 4 lakh rupees. Right? Step number 2, compute fair value less cost to sell. The question has given you fair value less cost to sell. Fair value less cost to sell on 30th September 20 is rupees 3,90,000. What is my carrying value? 4 lakh. What is my fair value less cost to sell? 390. What is lower? What is lower? 390 or 4 lakh? What is lower? Lower is 390. What is the next accounting entry? Non-current asset held for sale account debit 390. Impairment loss account debit on change in classification 10,000. 2. Property, plant and equipment credit 4 lakh rupees. This is the accounting entry. Correct? Is that clear? Is that clear? So friends, the criteria for held for sale is it has to be available for immediate sale in present condition and sale must be highly probable. The same criteria is there for group of asset also, means disposal group held for sale also. Correct? The measurement criteria for held for sale or disposal group held for sale is again same. The measurement criteria is step number 1, compute carrying value as per the respective standard. Step number 2, compute fair value less cost to sell. Step number 3, compute impairment loss. Correct? On account of change in classification, means step number 3 is recognize non-current asset held for sale or disposal group held for sale at lower of carrying value or fair value less cost. Right? Is that clear? The same concept applies to group of asset also. So there is a group of asset: goodwill, property, plant and equipment, inventory, financial assets, financial liability. This is a disposal group held for sale. correct? And under Ind AS, the property, plant and equipment would be stated at 26 million and inventory stated at $18 million, right? So as per Ind AS, matlab respective Ind AS. For example, for PP Ind AS 16, the value is given at $26 million. For inventory, the value is given at $18 million. What is my step number one? Compute the values, carrying value as per the respective standard. For these items, the revised value is not given, so we will assume that it is the same value. What is my step number two? Compute the fair value less cost to sell. It is given at $47 million. So what is my total value? What is my total value? Total carrying value. It is 16, it is 17, and it is minus 14. What is my revised carrying value as per step number one? It comes out at how much? 63. It comes out at 63. So my step number one, compute carrying value as per respective standard is 63. What is my carrying value? Sorry, what is my fair value less cost to sell? It is 47. So what is the differential? 63 and 47. What is lower? 47 is lower. So what is the differential? The differential is impairment loss of $16 million. Correct? The differential is $16 million impairment loss. So step number one, this is my step number one, remeasurement, measuring carrying value as per respective standard. Step number two, fair value less cost to sell. The difference is the impairment loss. You remember in the last class, if there is an impairment loss on a group of asset on a cash generating unit, first the entire impairment loss has to be charged to the goodwill. You can see the goodwill has become zero here. Correct? And these are the revised values. These are the revised. I believe and I'm assuming that you guys have already watched the last recorded videos on Ind AS 105. This standard was covered in two classes. Right, friends? How this disposal group will be presented? The total assets will be presented on the asset side. The liability has to be presented on the liability side. Non-current or disposal group classified as held for sale. Liability associated with disposal group as a held for sale. And it has to be shown under current asset. Correct? So let me tell you how this 61 has arrived. If you see the revised value of this disposal group held for sale, this 26 plus 18 plus 17, this comes out at 61. And this liability is 14. 61 minus 14, 47. So liability has to be shown on the liability side, asset has to be shown on the asset side. Correct? Is it correct? Yes. Okay. Now the third important concept I want to discuss. You remember I have told you when I was discussing sale is highly probable, I talk about five conditions. And the fifth condition was it is unlikely that the sale plan will change. It is unlikely. But the standard does not say that it is not possible. It is impossible that the sale plan will change. It is unlikely. It means even though 1% probability is there, 1% probability is there. And let me give you a real life scenario. You know, the COVID came in India and the lockdown was started in the month of March 2020. To be precise, it was 23rd March 2020. So there was a factory in Uttar Pradesh, UP, and the company was having two factories for manufacturing of sanitizers. And the company has decided to sell one of the factory in September 2019, before COVID came. And the company has classified one of the factory as a held for sale. Correct? But when COVID came, instead of selling that one of the plant for sanitizer, The company was thinking about acquiring one more plant for manufacturing sanitizer. And you have seen that in the COVID time, in the COVID time, everyone was manufacturing sanitizer. Everyone was manufacturing sanitizer in the COVID time. Correct? Hindustan Unilever, Dabur, Nestle, everyone was manufacturing sanitizer. So in this case, when the company has installed, constructed, or manufactured the plant, it was covered under Ind AS 16. When the company has decided to sell one of the plant and it was meeting the held for sale criteria, it comes under Ind AS 105. It comes under Ind AS 105. Right. But again, when the company has decided not to sell that plant but to use that plant, again it will go in Ind AS 16, right? PPE standard. Again it will go. So Ind AS 16 has its own recognition and measurement criteria. Ind AS 105 has its own recognition and measurement criteria, and we have seen that when an asset becomes held for sale, it has to be measured at lower of carrying value as per respective standard and fair value less cost to sell. The differential has to go to the P&L account as an impairment loss, right? And subsequently, on the reporting date, if the asset is not yet actually sold out, in that case, it has to be remeasured at fair value less cost to sell. Correct? So this is what we have discussed. But now, when the company, instead of selling that asset, company wants to use this asset, means this asset is no longer a held for sale asset. In that case, how this asset is going to be measured? Standard says that when HFS criteria is no longer met, the asset should be removed from the HFS category, held for sale category. It has to be reclassified and remeasured at lower of what? Again, you have to check two values, and whatever is lower, on that value, you have to recognize your property, plant, and equipment. You have to recognize your PPE. Number one, what is the carrying amount which would have been there if this asset has never been sold out? Sorry, if this asset has never been held for sale. अगर ये एसेट कभी हेल्ड फॉर सेल नहीं होती तो मेरी कैरिंग वैल्यू क्या होती? You have to compute the carrying value had this asset never been held for sale. Then what happened? The depreciation would have continued, correct? As you remember that once the asset become held for sale, the depreciation should stop, the amortization should stop, correct? जैसे आपका एसेट हेल्ड फॉर सेल होता है, आपका डेप्रिसिएशन और अमोर्टाइजेशन बंद हो जाता है, एंड यू स्टार्टेड रिकॉग्नाइजिंग द एसेट ऑन लोअर ऑफ कैरिंग वैल्यू एंड फेयर वैल्यू लेस कॉस्ट टू सेल, correct? So number one, you have to compute carrying amount, right? Considering what would have been the carrying value had this asset never been classified as held for sale. Number two, recoverable amount at the date of change to plan. Okay, and quickly we will discuss this again with the help of this example. A property is purchased for rupees 5 lakh. This is a very, I would say, a complete question on Ind AS 16 to Ind AS 105, Ind AS 105 to again Ind AS 16. This is a complete question. A property is purchased for rupees 5 lakh on 1st January 2019. The useful life of the property is 20 years, zero residual value. The property is measured subsequently at depreciated historical cost. On 31st December 2020, it is decided that the property is to be classified as held for sale. Classification criteria are met. The cost is 5 lakh, life is 20 years, zero residual value. The property is depreciated at cost model. What is my per annum depreciation? 5 lakh divided by 20, 25,000. Correct? 25,000. And this property was purchased on 1st January 19 and it become held for sale on 31st December 20, means after 2 years. What is my accumulated depreciation on 31st December 20? 50,000. What is my cost? 5 lakh. 5 lakh minus 50. What is my carrying value, which is cost minus accumulated depreciation? It is 450. Let me see if something is there for impairment. An impairment assessment on 31st December 20 determines the recoverable value based on value in use to be rupees 4 lakh. What does it mean? In this question, there is an impairment also. So cost minus accumulated depreciation minus impairment loss. What is my carrying value? What is my carrying value on 31st December 20? It is 4 lakh. It is 4 lakh. Correct? It is 4 lakh. If you see, my carrying value is how much? 5 lakh is cost, 50,000 is accumulated depreciation, 50,000 is impairment. My step number one carrying value is 4 lakh. You remember we have just done this calculation also in the last question. Now, the second part, the fair value less cost on 31st December 20 is rupees 3 lakh 90,000. The fair value less cost to sell on 31st December 20 is 3 lakh 90,000. So my carrying value is 4 lakh. My fair value less cost to sell is 390. What is the value of non-current asset held for sale? What is the value of non-current asset held for sale? Rahul, what is the value? The value of non-current asset held for sale is lower of 4 lakh and 3 lakh 90. 3 lakh 90. What is the accounting entry? Non-current asset held for sale account debit to PP account. So PP is 4 lakh. Non-current asset held for sale is 390. So differential of 10,000 will be debited to P&L as the impairment loss on change in classification. Okay. So this will be the accounting entry. Sir, this is what we have already discussed. Now, what is the new in this? Now, the new item comes. Okay. So this was from Ind AS 16 to Ind AS 105. Now, after 1 year, 31st December 20, 31st December 21, there is a change in plan and the property no longer meet the criteria to be classified as a. There is a change in plan and the property no longer meet the criteria to be classified as. Means now it has to be restated as PP. There is no change in the useful life of the property at any point of time. Means when it was purchased, it was 20 years. So it keeps on decreasing by 1 year. Okay, every year. The recoverable value is given. It is 3,85,000. It means now I need to compute what would have been the carrying value had this asset never been classified as held for sale. Tell me, अगर ये एसेट कभी हेल्ड फॉर सेल नहीं होता तो 31st December 21 पे कैरिंग वैल्यू क्या होती? And here the students make the error. Like Abracase, what Abracase has done, 5 lakh was the cost on 1st January 2019. It's been 3 years, which has already been passed. So he has charged 25,000 rupees depreciation every year. So 75,000 rupees is my accumulated depreciation. So he is saying carrying value is 4 lakh 25,000. Is that right? And this is where the students are making an error in the examination. And whenever this kind of question came, 75 to 80% of the student make a mistake. So Rahul, what is meant by carrying value? Cost minus accumulated depreciation minus accumulated impairment. Whether this definition is given in Ind AS 105 only? Answer is this definition is given in Ind AS 16 also, Ind AS 38 also, and Ind AS 40 also. This definition is given in PP, intangible asset, and investment property as this definition is given. Correct? So how does it matter? Even though you will not classify the asset as held for sale, if you are only doing the property, plant, and equipment accounting, will you check the impairment or will you not check the impairment? Tell me, the impairment assessment is only 105 item. Answer is no. And that is why the formula of carrying value itself says that cost minus accumulated depreciation minus impairment loss. Correct? So it means even though it is PP, you have to charge depreciation, you have to charge impairment, and whatever is the value, carrying value, the depreciation has to be charged prospectively. So tell me, in this case, what was the carrying value as per Ind AS 16 PP? What was the carrying value as per Ind AS 16 PP as per step number 1? This is the value as per Ind AS 16. This value is not as per Ind AS 105. This value is as per the respective standard, Ind AS 16. So 4 lakh is the value as on 31st December 2020. As on 31st December 2020. What does it mean? It means this has become the carrying value on 31st December 20. It means the 4 lakh needs to be depreciated in the remaining useful life. And what is the remaining life? What is the remaining life on 31st December 20? It is 18 years. It means, what is the next year depreciation? What is the next year depreciation? It is 4 lakh divided by 18. 4 lakh divided by 18. Correct? So 4 lakh has to be depreciated prospectively. You cannot ignore the impairment. So carrying value immediately prior to reclassification as held for sale is 4 lakh rupees. Depreciation charge for 2021 calendar year will be 4 lakh divided by 18, which is 22,222. Now, the carrying value which would have been on 31st December 21, had this asset never been classified as held for sale, 377,778. Recoverable value is given in the question. What is lower? The lower is 377,778. What is the accounting entry? PPE account debit. PPE account debit by 377,778. 2. NCHFS. NCHFS have been credited by which value? What was the value of NCHFS in this question? What was the value of NCHFS in this question? You are right, Rahul. 3,90,000. 3,90,000. Correct? So 390 is the value of NCHFS, which needs to be credited. Now, where the differential will go? The differential will go to impairment loss, balancing figure. Impairment loss on change in classification as held for sale. Impairment loss. Correct? Is that right? Impairment loss on change in classification from held for sale to PP. 10 and what is the value? 12,222 is the value. Okay. So friends, this case study number 5, and I have covered in the last batch also. So this case study is a good example to understand your Ind AS 16 to 105 means a non-current asset standard to a non-current asset held for sale, and non-current asset held for sale to again a non-current asset standard. So we have discussed the held for sale criteria, measurement for individual asset held for sale, disposal group held for sale, and the change in plan of sale. Now, what is discontinued operation, friends? For discontinued operation, standard provides more presentation and more disclosure criteria. A discontinued operation accounting is not given in the standard. Why? I'll give you 2 examples to make you understand this fact. Let's say I'm living in Gurgaon. Okay. I have an institute in Gurgaon, although I don't have, but just for the sake of explaining it, I am giving this example. So in my Gurgaon institute, I'm teaching financial reporting. I'm teaching Ind AS. I have an institute in Delhi where I'm teaching auditing. So friends, my Gurgaon operations are different. My Delhi operations are different. Okay? And what is a discontinued operation, right? So discontinued operation is nothing. It's a component of an entity. एक component होता है. Which component? Where the company, the management is measuring the financial performance, cash flows, and operational performance of that component as a separate thing. Correct? So this is those component where the management is focused about measuring the performance on an operational basis, cash flow basis, and from the perspective of financial reporting basis, financial reporting perspective. Okay. So friends, if I talk about my Gurgaon operations and my Delhi operations, tomorrow I have decided to discontinue my Delhi operation, my Delhi business. My students are different, my customers are different. I mean to say students are different, my subject is different. I can identify my revenue, my cost, because the staff is different.
correct? So I can identify my operation of Gurgaon and Delhi business. I can identify, I can distinguish, I can measure, I can evaluate both the performances of those both the operations separately, correct? So when I decided to shut down my Delhi business, my Delhi institute, whether shutting down the Delhi institute, Delhi business, Delhi operation is a discontinued operation, answer is yes. But now the point is, for this discontinued operation, when I'm shutting down my Delhi operation, my Delhi institute, now I have two options. Option number one, whatever assets were there in my Delhi institute, like I do have furniture and fixture, I do have air condition, water purifier, coffee and tea vending machines, oven, right? Projector, computer, laptop, a chair, table, a library. I do have a lot of things in my Delhi institute. So when I've decided to shut down, I have two options. Option number one, I will sell the entire Delhi Institute asset. Option number two, I can use those Delhi Institute asset in my existing business in Gurgaon. So when I decided to sell my asset, although this is a discontinued operation, but this discontinued operation is a disposal group held for sale as well. So I have to do the accounting of disposal group held for sale, where I need to compute the carrying value on the date of classification is held for sale. I need to compute the fair value less cost to sell, right? And then I need to measure at lower, and then I need to charge impairment loss. Okay. So when I've decided to sell my group of assets in Delhi, the accounting will happen as a disposal group held for sale, and the separate and additional disclosure requirement will be there, which will say that the result of discontinued operation has to be shown separately in the P&L. The earnings per share of continued operation, discontinued operation has to be shown separately, and the total operation has to be shown separately. Correct? Friends, when I'm deciding and when I've decided to use those assets in my existing business, in that case, there is nothing called as a disposal group held for sale. But yes, it is a discontinued operation because I've shut down my auditing business. I will not have a revenue going forward from my auditing business. Correct? So for the user of the financial statement, it is important to understand the business which the company has shut down, stopped, discarded, disposed of. What was the revenue? What was the cost from that business? Right? It has to be shown separately. And hence, the discontinued operation has to be shown separately in the profit and loss account, the results. Okay, it has to be shown separately. Like this is my continuing operation, this is my discontinued operation. So the net profit has to be shown separately from discontinued operation, and this has become the total profit. And the in detailed P&L, the detailed P&L, revenue, cost, PBT, tax, profit after tax, this has to be shown in the notes to accounts. Okay, this is how this disclosure has to happen. Differences I'm not covering. Correct. So quickly, some MCQs. An entity can continue to depreciate an asset even if it classifies it as a non-current asset held for sale as per Ind AS 105. Tell me, when it is classified as a held for sale, whether it is required to depreciate? Answer is no. It is false. Whenever the asset is classified as held for sale, the depreciation stopped automatically. For asset classified as held for sale, it must be presented under the appropriate asset head with a separate disclosure in the note. Means, if it is a building held for sale, it has to be shown in the building only. Answer is no. Whatever asset held for sale is there, it has to be shown separately under current assets. Okay, it is false. Under Ind AS 105, an entity is committed to distribute the asset or disposal group to the owners, the asset must be, what is the right answer? Available for immediate distribution in their present condition, and distribution must be highly probable. Available for immediate distribution in their existing condition, and distribution must be virtually certain. Available for immediate distribution in their existing condition, the distribution must be reasonably certain. Available for immediate distribution in their present condition, distribution must be virtually certain. What is the right answer? A is the right answer. Correct. Last question on the change in plan. How to measure a non-current asset or disposal group that ceases to be classified as held for sale? Means now it is no more held for sale. Now it is a normal asset. Tell me. Option number A, lower of carrying amount which would have been had the asset never been classified as held for sale and recoverable. Option number 2, lower of carrying amount on that date asset ceased to be classified as held for sale and recoverable amount. Lower of carrying amount on the date asset ceased to be classified as held for sale. So option number 2 is talking about the actual carrying value. It is not deemed carrying value, actual carrying value and recoverable amount. So this is not a right option. Lower of carrying amount and fair value less cost to sell, not a right option. Lower of carrying amount and the amount which would have been had the asset never been classified as held. So what is the right option? Option number A is right option. So deemed carrying value and recoverable value. Okay. And this is your favorite slide. Thank you so much. I have completed Ind AS 105. Now, if you have any question, I would be happy to answer. So Ashok ji, please unmute the participants. Participants, let me know if you have any question on Ind AS 105. Any student, any participant, Abrikes, Rajiv, Viraj, in case if you have any question, do let me know if you have any question.
Sir, Abhrakesh.
Yes, Abrikes, please.
Sir, in that combined example, first it has been held for sale and then ceased to be held for sale. So we have taken, so we have to see in continuation. So as of December 20th, whatever the amount, we should go ahead from that amount only for carrying amount, I mean. Because I have written wrong amount because 5 lakhs minus 75,000.
Yes. So Abrikes, generally what happens even in practical life also, right?
Hmm.
Whenever you do the PPE accounting,
Hmm.
so every company has fixed assets, okay?
Hmm.
Every company has a depreciation. Every
Yes.
company has a fixed asset register.
Yes.
So whenever you charge depreciation,
Hmm.
you are always charging the depreciation on the carrying value, right? This is the mool mantra
Okay.
for the depreciation. For example, I'm assuming a very clear-cut case where, let's say, the vehicle is there, the car has been purchased. The
Hmm.
car was purchased for rupees 10 lakh, right?
Hmm.
The
Yes.
life 10
Okay.
year. The life was 10 year, and during the life there was no impairment.
Hmm.
Okay.
Hmm.
So let's say if I'll say the life is 10 year, zero residual value, cost is 10 lakh. What is my per annum depreciation? 1 lakh,
Yes.
right? And how will you arrive at 1 lakh? 10 lakh divided by 10
Yes.
comes at 1 lakh,
Straight line.
or 10 lakh divided by 10 is 1 lakh, or at the end of the first year, 10 lakh is the cost minus 1 lakh is the depreciation. So 9 lakh is the carrying value at the end of 1 year,
Yeah. WDV. Yeah.
WDV.
Yes.
If I'll say that whatever is WDV or carrying value at the end of 1 year is there,
Hmm.
that will become your opening value, and you have to charge the next year depreciation on this opening value. So 9 lakh is my opening value at the beginning of the second year.
Yes.
Now, what is my depreciation? 9 lakh divided by remaining life. What is my remaining life? 9 years.
9 years. So
Nine.
again,
So
1 lakh.
9 divided by 9 is 1 lakh.
Yes.
At the end of second year, my carrying value or WDV will become 8 lakh.
Yes.
Remaining life is 8 years. Again, third year, your depreciation will be 1 lakh only.
Hmm. Yes.
So, in case where there is no impairment, correct? If
Hmm.
you will compute the total life, if you will compute the
Okay.
total depreciation from your original cost divided by total life, the answer will be same.
Yeah.
or the WDV divided by remaining life, the answer would be same.
Yes.
But the basic thing is you have to compute your depreciation every year on the basis of WDV divided by remaining useful.
Yes.
In this case, whenever you opt for this, your answer will always be right. When there is an impairment, there is no impairment, there is a revaluation, whatever is there, just pick the opening value, divide by remaining life. That will be your that year or that period depreciation.
Okay.
Okay.
So yes. So that is after impairment loss, if any. So in that example, it was impairment loss of some 50,000 was there.
Correct. Correct.
So we should take 4 lakhs. Matlab we should continue from 4 lakh only, not
Yes.
from. Okay. So after impairment loss also. Okay. Okay.
Yes. But let's say in the next year, as I told you in PP standard also, in the
Hmm.
next year, some favorable conditions are there and
Hmm.
the market value of the PP has gone up,
Okay.
right? So that
Okay.
impairment loss can be revised also in PP. It can
Okay.
be reversed.
Okay.
So let's say if tomorrow it will be reversed.
Okay.
And now the value has become higher. So
Okay.
you have to compute depreciation on the remaining life on the basis of this higher value.
Okay. Got it.
Correct?
Yeah. Thank you.
Any other question, friends? Any other question? Yes, Rahul has a question on the query box and he is asking, sir, example, the property was classified as held for sale on 1st July 2023, correct? And the period is 1 year that you have to sell within 1 year. On 31st March 2024, the property has not actually been sold out. Whether we are required to do any remeasurement on the reporting date. So, Rahul, I would be happy to answer this question, but I think you have not watched the last videos. Last videos means of on Ind AS 105. So, the initial measurement is cost, initial measurement of NCA HFS under Ind AS 105 is carrying value or fair value less cost to sell, whichever is lower, right? For example, the carrying value on 1st July 2023 was, let's say, 5 lakh rupees. The fair value less cost to sell was 4 lakhs 80,000 rupees. So we have recognized NCHFS at 4 lakh 80,000 rupees, correct? And 20,000 has been recognized as an impairment loss. So standard says that on the reporting date, you have to remeasure your NCA on the basis of fair value less cost to sell only. So now again, I need to compute my fair value less cost to sell on 31st. Suppose the fair value less cost to sell become 4 lakh 60,000. Again, I need to take an impairment loss of 20,000. I have to decline the value of NCHFS to 4 lakh 60,000. Correct? Now suppose instead of 4 lakh 60,000, instead of the value has become higher and now it become 5 lakh 10,000. What was my value of NCHFS? 4 lakh 80,000. Now it has become 5 lakh 10,000. Correct? So friends, do I need to take this increase of 30,000? Standard says that whenever your fair value less cost to sell is increased, right, in comparison to your initial measurement of NCHFS, you have to take the increase only to the extent of past impairment losses. You have to take the reversal only to the extent of past impairment losses. You remember the carrying value was 5 lakh. The fair value less cost to sell was 480. So we have taken the impairment loss of how much? 20,000. And now the increase is 480 to 510. 30,000 is the increase. So we will not take the increase of 30,000. We will take the increase only to the extent of last decrease. Last decrease was 20,000. Previous decrease was 20,000. So we have to take the increase only to the extent of 20,000. And what is the accounting entry? NCHFS account debit 20,000 to impairment loss reversal 20,000 in the P&L. Correct? So now this NCHFS become 5 lakh. Is that clear? Rahul, I hope it is clear to you. Yes, I hope it is clear to you. Okay. So friends, it's 8:18 now and I have completed completely Index 105. Let's have a 10 minutes break and we will start at it's 8:19 now rather. Let's start at 8:30. Okay. The second standard I am taking is Ind AS 23, borrowing cost. So this standard was supposed to be taken in the last class, but in the last class, Ind AS 36 impairment was there, and I have covered it in detail. And hence, we were not able to cover that standard. So I am covering this Ind AS 23 today. So students, to explain Ind AS 23, and I will be, covering the two important questions of Ind AS 23, correct? And with the help of these questions, I would be discussing the concept of Ind AS 23, right? I hope this word file is visible. I hope this word file is visible. Okay. Yeah. So Ind AS 23 is borrowing costs. Okay. Normally, whenever you heard something called as a borrowing cost, the first impression which comes into our mind is P&L. Correct? Borrowing cost is kind of an expense. It is a cost of the borrowing. It is like interest, processing fee, commission. So this borrowing cost is nothing. It's a kind of an interest cost. It's a cost which has to be charged to the P&L. Correct? So now, why this why guidance? Is it something which we are talking about P&L? Is it something which we are talking about capitalization? Yes. There is a special standard on borrowing cost because here we are not talking about P&L. Here we are talking about capitalization. Here we are talking about making an interest cost, making a borrowing cost as a part of the intangible asset or property, plant and equipment or inventory or investment property. Correct? We are talking about that way. So that is why if you are capitalizing borrowing cost, there has to be some principle. Correct? And standard says that borrowing cost will be capitalized to a qualifying asset, right? Borrowing cost will be capitalized to a qualifying asset. And what is a qualifying asset? So qualifying asset is an asset which takes a substantial period of time for getting ready for intended use or sale. For getting ready for intended use or sale. For example, I have purchased a plot of land and I am just splitting it into the land parcels. For example, there is a 1000, there is a 10,000 square feet of land and I've split it into 10 plots of 1000 square feet each. In this case, my intention is to sell the land after cutting it between the different land parcels, different plots of land. Whether just splitting this 10,000 square feet into 1000 square feet, whether it will take a substantial period of time? Answer is no, it will not take a substantial period of time. Correct? I am doing a demarcation. There is a land, but if my intention is to construct, my intention is to develop, my intention is to construct, my intention is to develop this land, my intention is to construct bungalow or I would say flats, and then I will sell those flats. So my intention is to develop, okay, which takes a substantial period of time. And now this will become a qualifying asset. Okay, this will become a qualifying asset. So friends, that is why the definition is qualifying asset are those assets which takes a substantial period of time for getting ready for intended use or sell. For getting ready for intended use or sell means what is the intention of the management, and any borrowing cost which is directly related to the acquisition, construction and production of a qualifying asset has to be capitalized as a part of the qualifying asset. Correct? This was the definition of qualifying asset and the borrowing cost. Now, what is a borrowing cost? So, borrowing cost could be your interest cost, which is directly related to the borrowings, which is directly you are paying on the borrowings, or processing fee, which you are charging, processing fee, which you are getting charged by the bank. You understand the processing fee, which bank is charging. Okay. Or any commission, brokerage, or anything, the cost which is directly related to the procurement of borrowings. Okay. So that is your borrowing cost. That is your borrowing cost. Okay. Or if for construction of a qualifying asset, you have taken an asset on a lease basis, which is used for the construction of a qualifying asset. And when you have taken an asset on a lease basis, you are applying Ind AS 116 accounting. You are capitalizing lease liability, you are capitalizing right of use asset. So on lease liability, you are also paying an interest. So that interest is also like a borrowing cost, which is going to be capitalized as a cost of qualifying asset. So borrowing cost details are there, and I have covered this entire Ind AS 23 in the one class, which is 3 hours of a class. So what is a substantial period of time? What is a qualifying asset? Qualifying asset is an asset which takes a substantial period of time. In accounting standards, substantial period of time is defined as more than 12 months, 12 months or more. In Ind AS, it is not defined, but the company may make a policy that substantial period of time is beyond 1 year, means beyond 12 months. Okay. Means which takes a major amount of time. Okay. So friends, whenever an item, an asset will take a substantial period of time for getting ready for intended use or sale, it will be considered as a qualifying asset. And if you have taken a borrowing for the purpose of a qualifying asset, the cost of the borrowing till the time this asset is ready for use, the cost of the borrowing is going to be capitalized as a part of the cost of that asset, right? So this is how this borrowing cost measurement is there. And one of the aspect in borrowing cost, it was also given that if you are taking a borrowing in the foreign exchange, right? Of course, you would have an interest payment, interest obligation, and you may enter into a exchange loss situation as well. When the dollar is appreciating and the rupee is depreciating, so probably you will have an exchange differential loss also. Standard says that exchange difference loss can also be capitalized to the extent of the difference between the interest rate or interest expense in terms of foreign currency rate and in terms of domestic currency rate. Correct? And one of the question we have discussed in the last class around that. Now, friends, the standard says that borrowing could be a general borrowing, could be a specific borrowing. Correct? What is meant by specific borrowing? For example, if I purchased a machinery and I've taken a loan on that machinery, correct? So this loan is directly related to that machinery. So whatever interest I am bearing, whatever interest I am paying, that interest will be capitalized to the machinery till the time this machinery is ready for use. Correct? So this is a specific case, like the house you are purchasing and home loan you are taking. So in the home loan, your house address will be there even. So it is a specific loan. What is a general rule loan? Generally, big companies, what they are doing, they are procuring funds from the various sources and they are making a pool of the funds as a general pool, right? As a general pool. Like you have seen swimming pool. Let's say the water is coming from the four sources, but swimming pool is a pool of water. So the Treasury Department has 1,000 crore of funds, and these funds have come from various sources. They have taken from Bank of Maharashtra, State Bank of India, Allahabad Bank, issuing debentures. So they have done a lot of things. Okay. And at a different interest rate. So now they have got a pool of funds. And now they are deploying this pool of funds into various utilization. For example, construction of plant, for example, purchasing of building, for example, for working capital purpose, paying salaries, right? So it's a general pool. So either it could be a case of specific borrowing or either it could be a case of general borrowing. The specific borrowing case is pretty simple. When you took a loan for the purpose of purchase of a specific asset or construction of a specific asset, you have to capitalize that cost of the borrowing to that asset, correct? And while computing the cost of the borrowing, if you have some idle funds which are there, right? For example, if you have taken a loan for the purpose of construction of a building, so all the funds will not be deployed on the first day, correct? You took a loan of, let's say, 10 lakh rupees, and you are deploying gradually. So you are parking your funds, idle funds, into some temporary deposits, which will give you some temporary income also. So standard says that in case of a specific borrowing, cost of the borrowing minus income generated from the temporary deposits or temporary funds. So that has to be deducted. The net is required to be capitalized to the cost of the asset. If it is a case of general borrowing, in that case, you have to compute the weighted average rate of the borrowing. For example, the company has taken a loan of 100 crores at a 10%, 100 crore at 11%, 100 crore at 12%. So what is my interest cost? On 100 crore, 10% is 10 crore, 11% 11 crore, 12% 12 crore. So what is the total interest? Total interest is 10 plus 11 plus 12. How much it is coming? 11 plus 10, 21, 21 plus 12, 33. 33 crore is the total interest cost. What is my total loan? 100, 300. So 33 divided by 100, 33 divided by 300. How much it is coming if I'm computing 33 divided by 300? How much it will come? 33 divided by 300? Me. 11%. So my weighted average rate of borrowing is 11%. Now, by the time I'm utilizing my funds, right? For example, I have put, let's say I have used 10 crore in the construction on 1st of April, right? And I am computing the cost to be capitalized on 31st March. So 10 crore I have used for entire 1 year. So 10 crore multiply by 11%. Okay. Then on 1st October, I've used 5 crore. So 5 crore I've used for 6 months. So 5 crore multiply by 6 by 12 multiply by 11%. So this is how you will compute your cost of the borrowing to be capitalized in case of general pool. In case of general borrowings, you have to compute the weighted average rate of borrowing. And how this weighted average rate of borrowing will be arrived? Total interest cost divided by total portfolio of the general borrowing. This will give you the weighted average rate, right? And the amount which you have utilized for a various period of time. Okay. So when you apply this weighted average rate to the utilization, it will give you the cost of the borrowing to be capitalized. Okay. So friends, I am discussing one of the question of FR study material module 2, chapter 6, unit 3 from test your knowledge question number 4. Correct. And before that, one of the aspect that the borrowing cost is going to be capitalized from commencement date. You must have heard about the concept of commencement date. What is meant by commencement date? Commencement date is a date when, number one, the loan has been taken, means borrowing has been incurred. Number two, the cost or expenses has been started incurring, right? Number three, the activity necessary to bring the asset into the location and condition for the intended use or sale has been started. So activity to prepare the asset has been started, right? So this is the meaning of commencement date. So now we will discuss, with the help of this question, we will discuss the concept of this measurement of cost of the borrowing to be capitalized. K Limited began construction of a new building at an estimated cost of 7 lakh on 1st April 2001, 20x1. 7 lakh. Friend, K Limited began a construction of a new building at an estimated cost of 7 lakh. Estimated cost means K Limited has estimated that the cost is 7 lakh. To finance construction of the building, it obtained a specific loan of rupees 2 lakh from a financial institution at a rate of 9% per annum. The estimated cost is 7 lakh, but the company has taken a specific loan of rupees 2 lakh only. And what is the interest rate? 9%. Is this a general borrowing or is this a specific borrowing? 2 lakh rupees. 2 lakh is dedicated borrowing, specific borrowing, correct? The company's other outstanding loans were 7 lakh rupee of loan which the company has taken at an interest rate of 12%. 9 lakh rupees of loan the company has taken at an interest rate of 11%. So 2 lakh rupees specific loan, and there are two general pool loan also. 7 or 9 means 16 lakh rupees loan. Expenditure incurred on the construction was in April 2001 1 lakh 50,000, August 2 lakh 350, October and January 1 lakh. The total expense incurred on construction was how much? 1.5 plus 2, 3.5, 3.5 plus 3.57 and 1.8. The total expense incurred was 8 lakh. It was an estimated cost of 7 lakh, right? So the first learning in this question is don't make your conclusions till the time you read the question completely. This cost was 7 lakh, but the actual cost incurred was 8 lakh. So you have to do all those calculations as per 8 lakhs, correct? That was the estimated cost. This was given just to confuse, right? The construction was completed on 31st January 20x2. So it was started in April and it was completed on 31st January 20x2. Okay. Following the provisions of Ind AS 23 borrowing cost, the requirement of standard is following the provisions of Ind AS 23, you are required to compute the amount of interest to be capitalized, and pass necessary journal entry for capitalizing the cost and borrowing cost in respect of the building as on 31st January 20x2. Correct? Let's start solving this question. First of all, a specific loan of 2 lakh is there. General pool of borrowing 16 lakh is there. Correct? So first we will use this loan has been taken for the specific purpose. So we are assuming this 2 lakh rupee has been utilized, right? Has been utilized first for the purpose of construction of this building. Correct? First, we have to calculate the capitalization rate on borrowing other than specific borrowing, right? What we are computing. So for specific borrowing, you are not required to compute any rate because it is specific. It is single borrowing which is there for that purpose. But now you need to compute the weighted average rate of general borrowing. How it is computed? 7 lakh rupee is the amount of the loan. 7 lakh rupee, correct? 9 lakh rupees is the another loan. Total loan is 16 lakh rupees. Rate of interest is 12% and 11%, which is given in the question. 12% and 11%. Now you need to compute the rate amount of interest. How will you compute amount of interest? Principal multiplied by rate of interest. 84,000, 99,000. The total interest is 1,83,000. 183 divided by 16 lakh will give you the weighted average rate of interest. 11.44% is the weighted average rate of interest. Now we have the rate of specific borrowing 9%. We have the weighted average rate of general borrowing 11.44%. Now we need to capitalize the borrowing cost, right? For specific borrowing and general borrowing, we need to compute the borrowing cost which needs to be capitalized. First of all, what is the date on which the expenditure have been incurred? 1st April, 1st August, 1st October, 1st January. Correct? Amount spent. On 1st October, the money was spent at 1.5 lakh. 1st August, 2 lakh, 3.5 lakh, 1 lakh. This is given in the question. finance through. Now, the first 1.5 lakhs, what would I say? What would I say? ये पहला 1.5 लाख रुपए कहां से फाइनेंस हुआ होगा? First 1.5 lakh would have been financed through specific borrowing. And but the specific borrowing is 2 lakh. It means the another 2 lakh, out of another 2 lakh, 50,000 would have been financed from specific borrowing, and remaining 1.5 lakh would have been financed from the which general pool borrowing. Is that clear or not clear? Tell me. मतलब पहले 2 लाख 1.5 lakh on April 1 and 50,000 out of this 2 lakh which was expensed on August 20x1. Out of that 50,000 was utilized from the specific borrowing, correct? And the remaining funds were utilized from the general borrowing, correct? So this is how this calculation has been happened. 1,50,000 multiply by the rate of the specific borrowing, multiply by 10 divided by 12. Why 10 divided by 12? Why it has been calculated for 10 months, Viraj? Yes. Rahul is saying something. Let me see the query box. Yes, Rahul, you are right. Because the capitalization date is 31st January 20x2, right? If you see in the question it is given. If you see in the question, it is given in the question that the asset is available for use on 31st January 20x2. The construction of the building was completed by 31st January 20x2. Correct? 1st April to 31st January 20x2. It is coming at 1,50,000 multiplied by 9% multiplied by 10 by 12. The next expense is 2 lakh rupees, which was expensed on 1st August. So I will split this into two parts. 50,000 I have utilized from the specific borrowing, correct? And 1,50,000 I will utilize from the general borrowings, correct? From the general borrowings. Is that right? Is that right? So this borrowing, this specific borrowing, I have already taken on 1st April 2001, correct? So in case of a specific borrowing, whatever amount you have taken for that specific borrowing and the construction has started, the entire amount is going to be capitalized for that specific borrowing. And you can see, while the expense was incurred on 1st August, but for 50,000, the money, the interest calculation was taken for 10 months. Is that clear? ये समझ में आया? Is that clear? For this specific borrowing, while the money was utilized, expensed on 1st August, but the calculation was happened from 1st April only. Why? Because it is a specific borrowing. It is specifically taken for that purpose. It cannot be used anywhere else. Correct? And that is why in case of a specific borrowing, whatever is the cost of the borrowing till the time the asset is available for use, till the time, you have to capitalize the entire cost minus, if you have generated some income from the idle funds, you can minus that. But for general borrowing, 1.5 lakh, multiply by 11.44%, and the period is only 6 months, from 1st August to 31st January, right? From 1st August to 31st January, correct? So we have calculated for 6 months. For the expense which we have incurred, we have taken the funds from the pool of the general borrowings, 3.5 lakh multiply by 11.44% multiply by 4 by 12. The period in which we have used these borrowings. On 1st January 20x2, it is only for 1 month, 1 lakh multiply by 11.44%, multiply by 1 by 12, right? And it is coming out at 37,875. the total interest cost which is going to be capitalized is 37,875. Since construction of building started on 1st April 20x1, it is presumed that all the later expenditure on construction of building had been incurred at the beginning of the respective month. In the standard, in the stand, sorry, in the question, the date of the date was not given. The date was only given for the first case, which is 1st April, but for the remaining period, the date was not given. It is August, October, and January only. That is why one of the note which have been put in this question is we have assumed that the amount has been incurred, the construction cost has been incurred on the first of the month. Correct? Now, what is my total expense to be capitalized in the building? The total cost was 8 lakh rupees, 1.5 plus 2 plus 3.5 plus 1. Interest cost capitalization 37,875. The total cost of the building is 837,875. What is the accounting entry? Asset needs to be capitalized. Building account debit 837,875. Correct? Building account debit 837,875 to bank. The amount expensed on the construction of the building, to interest payable, assuming that interest has to be paid at the end of the year, 37,875, right? And in the question, this assumption has also been given. In the above general entry, it is assumed that the interest amount will be paid at the year end. Hence, entry for interest payable has been passed on 31st January 20x2. Alternatively, following journal entry can be passed. Building account debit to bank account, entire money 837,875. Any question in this question? Any question in this question? Abrakesh and Viraj, Rahul. Any question on Ind AS 23? So Abrakesh is asking why bank loan, why not bank? Abrakesh, I haven't understood your question. Abrakesh, can you unmute yourself and ask the question?
Yes, sir. Sir, my question is why bank account is been credited? Why not bank loan account? So it's okay if one is the same is considered. Because ultimately, we have taken loan from the bank, no?
Abrakesh, when the loan was taken?
Yes.
When loan was taken? I'm asking you.
Oh, specific on the 1st of April.
Specific on 1st of April, right?
Yeah, and balance on respective date.
The question was silent about the general loan, but the question is saying that these other outstanding loans were. It means these loan have been taken prior to that or on 1st April.
Okay.
Correct. So I am capitalizing on 31st January 20x2. As all these loans were taken on 1st April 20x1. So when the loan was taken, what was the accounting entry at that point of time?
Okay, bank account debit to bank loan account. I mean, long term
debit bank loan account. So you have already taken a bank loan.
Okay.
Money has been credited in your bank account. Now you are withdrawing the money from the bank account for the purpose of expense of.
Yes, sir.
So that is why in case of specific borrowing, the specific purpose was the construction, and hence the money was, the cost of the borrowing was capitalized for the entire amount of loan. Doesn't matter you have utilized, you have not utilized, you have utilized partially, you have utilized for a small amount of time, doesn't matter. It has to be capitalized till the time the asset is ready for the use. Correct. But for the general borrowing, the purpose is general. The purpose was not only construction. So that is why you have computed the weighted average rate of capitalization, weighted average rate of borrowing, and whenever you are withdrawing money from the pool, you are only capitalizing the interest to the extent of utilization.
Okay.
Correct. And that is why the bank account was credited because the money has come to the bank.
Yes, yes, that's true, sir. Okay, okay. Thank you.
Any other question? Cover one more question on this, and this is a very important and little complex question. And this question is question number 6 of May 2023 of RTP of FR under old scheme. Correct? The scheme was old, but the concept is as pretty as new. Okay? The same concept is there. LT Limited is in the process of constructing a building. The construction process is expected to take about 18 months. It is expected to take about 18 months, means substantial period of time. From 1st January 20x1 to 30th June 20x2. From 1st January to 30th June. The building meets the definition of a qualifying asset. Correct? Question has been given. It is given in the question, even though if the question was silent. So this is a substantial period of time. LT Limited incurs the following expenditure for the construction. The construction started on 1st January. So they have incurred 5 crore on 1st January. Correct? On 30th June 20 crore, on 31st March 20 crore, on 30th June 20x2 5 crore. Here the dates are given. In the last question, the date was only given for the first date, 1st April 20x1. But here 1st January, 30th June, 31st March, and 30th June, the dates were given. You are not required to assume anything. On 1st July 20x1, July means after these two expense, after incurring of these two expense, two money, two amount. After 30th June 20x1, that is on 1st July 20x1, the company has issued 10% redeemable debenture of rupees 50 crore. Right? The total construction cost of the building was 50 crore, and the company has raised money by way of debenture of rupees 50 crore. The proceeds from the debenture form proceeds from the debentures form part of the company's general borrowing, which it uses to finance the construction of the asset, that is the building. Right? It says that the money which was generated from the issuance of debenture, it is part of a general borrowing, and the part of the money is going to be used to finance the construction of the qualifying asset. So it is part of the general borrowings where they have to finance the construction of the qualifying asset also. And the company does not have any borrowing for specific before 1st July 20x1 and did not incur any borrowing cost before that date. This is the first borrowing. The company had incurred 25 crores of construction cost before obtaining general borrowings on 1st July 20x1. Right? The company has incurred 25 crores of construction cost before obtaining general borrowings on 1st July 20x1, which is a pre-borrowing expenditure. Correct? And 25 crore after obtaining the general borrowing, which is a post-borrowing expenditure. So company has obtained or company has spent 25 crore rupees, which is clearly evident. 1st January and 30th June, which is before borrowing, and 25 crore the company has spent after borrowing, after issuance of debenture. For each of the financial years ended 31st March 20x1, x2 and 20x3, calculate the borrowing cost that LT Limited is permitted to capitalize as a part of the building cost. So in this question, 3 financial years are there. After incurring an expenditure of rupees 5 crore on 1st January, the next the financial year ending will be on 31st March 20x1. Then the company has incurred 2 expenditures, 30th June 20x1 and 31st March 20x2. The company will close the second financial year, which is 31st March 20x2. Then the company will spend 30th June 20x 5 crore. And the third financial year will be 31st March 20x3. So you need to compute the borrowing cost which is going to be capitalized for the period ending 31st March 20x1, 31st March 20x2, and 31st March 20x3. Correct? The borrowing was started on 1st July 20x1. It means there was no borrowing for the period ending 31st March 20x1. The borrowing was taken in in the financial year 20x1 x2. Now, friends, tell me, are you clear about this question or whether the question is not clear? Tell me whether question is clear or question is not clear. Tell me. Not the answer. I'm asking about the question. Viraj is saying it is clear. Rahul is saying it is clear. What about others? Abrakesh is saying it is clear. Okay. Now, friends, standard says that the company has to begin capitalization of borrowing cost from the commencement date. And commencement date begins when three conditions will be satisfied. Number one, the borrowing has to be taken. Number two, the expenditure on the asset has been started. Number three, the activity to prepare the asset has been started. In 31st March 20x1, the expenditure on the asset has been incurred, the construction activity was started, but the borrowing has not been incurred. The borrowing has not been incurred. So do we capitalize any amount? Do we capitalize any amount for the year ending 31st March 20x1? If the actual interest was not there, how can I capitalize? Correct? So on 31st March 20x1, it is quite clear that you are not required to do anything. You are not required to do anything. Correct? Is that clear? Is that clear? So there is no any cost which is required to be allocated to the 20x1, 2000x1, right? Borrowing cost capitalization is zero. Now we need to compute the calculation of borrowing cost for financial year 20x1, 20x2. Correct? Friends, when the borrowing has been taken, when the borrowing has been taken, the borrowing has been taken on 1st July 20x1. So in the financial year FY 20x1, x2, in this financial year, what is the period for which the company has to pay the interest cost? What is the period? 9 months. From 1st July to 31st March, 9 months. 30th जून तक तो बोरोइंग ही नहीं थी, तो कोई इंटरेस्ट कॉस्ट भी नहीं थी. So this is only a single borrowing which is debenture at 10%. The borrowing has been taken on 1st July. The rate of interest is 10%. Correct? So the time we have spent money, we have incurred the money, we have incurred the expenditure, we have to take that expenditure, multiply by time period, multiply by interest. It will give you the rate. It will give you the amount of interest which is going to be capitalized. Correct? But in this question, amount of 25 crore was spent prior to taking the borrowing. Right? And remaining 25 crore was spent after borrowing. So there is one paragraph, and it is paragraph 14 of Ind AS 23. It says that Ind AS says that the entity does not disregard the expenditure on qualifying asset. The entity does not disregard the expenditure on the qualifying asset incurred before the entity obtains the general borrowing. Right? If you will think in this question, the cost of the construction was 50 crore and the company has taken a debenture of 50 crore. It has raised the money from the debenture for 50 crore. It means probably there was taking some time for the issuance of these debentures, and probably the timing has not been matched, but the company has to start the construction. So probably the company has used the funds which was taken for some other purposes, or it was from some general purposes, or the company has used the internal accruals of the company for the purpose of construction, and thereafter the company has taken the loan, and the company has financed the money to those purposes. So standard simple says that while computing the cost of the borrowing cost to be capitalized by way of general borrowing, you cannot disregard the expenditure which have been incurred before taking the borrowing, right? Before taking the borrowing. So you cannot disregard the expenditure, and you need to compute the weighted average accumulated expenditure. Weighted average accumulated expenditure, right? Weighted average accumulated expenditure after the borrowing has been made. So two learnings from this question. Question number one, two learning from this question. Learning number one. अगर आपने कोई जनरल बोरिंग ली है कंस्ट्रक्शन स्टार्ट होने के बाद, मींस ड्यूरिंग द पीरियड ऑफ क्वालिफाइंग एसेट, तो आपने जो बोरोइंग से पहले का आपने जो अमाउंट बोरोइंग से पहले का आपने जो अमाउंट स्पेंड किया है, यू कैनॉट डिसरिगार्ड दैट एक्सपेंडिचर, राइट? यू हैव टू consider those expenditure for the purpose of calculating weighted average accumulated expenditure. ठीक है, बट वो कौन से पीरियड का कैलकुलेट करोगे? यू हैव टू कंप्यूट ओनली आफ्टर when the borrowing has been taken. So in 20x1x2, what is my expenditure? My expenditure on 1st January was 5 crore. My expenditure on 30th June was 20 crore. 31st March 2002 is 20 crore. Total expenditure is 45 crores, which have been already incurred till 31st March 20x2. What is my capitalization period in the current year? Means which period the borrowing is cost is going to be capitalized. This 5 crore was there for entire 9 months, because this 5 crore has been spent prior to 1st July 2000 x1. So this 5 crore is for the entire 9 months. This money of 30 June 20x1, which was spent on 30 June 20x1 for 20 crore, this is again for the entire 9 months, because it has been taken prior to 1st July. ये दोनों बोरिंग तो 1 जुलाई से पहले की है ना, मतलब 1 जुलाई से लेकर 31st मार्च तक ये पूरे 9 मंथ्स में ये वाला पैसा, ये वाला स्पेंट, ये एक्सपेंडिचर ऑन कंस्ट्रक्शन इट वाज देयर, करेक्ट? आई एम कंप्यूटिंग वेटेड एवरेज expenditure. And the last one is 31st March 20x2, which is 0 by 10. It means it is on the last day. The weighted average expenditure is nil. 5 crore multiplied by 9 by 12, it is 3.75. The next one, 20 crore multiplied by 9 by 12, it is coming out of 15 crore. A weighted average accumulated is 18.75 crore. I have computed for 20x1x2, I have computed what is my weighted average accumulated expenditure, and it gives me 18.75 crore. Now, since I have already given the weightage of the time period, I have actually computed what is my weighted average accumulated expenditure during the period for which I am paying the interest cost. So now what is my borrowing cost eligible for capitalization? 0.75 crore multiplied by interest rate, which is 1.875 crore. Correct? LT Limited cannot capitalize borrowing cost before 1st July 20x1. Why? Because actual borrowing was not there. The day it starts to incur borrowing cost, correct? It has to capitalize after 1st July 20x1. Accordingly, this calculation uses a capitalization period from 1st July 20x1 to 20x2. Whether the calculations are clear, so far, 20x0x1, 20x1x2, is that clear or not clear? Any doubts so far? Percentage, are you talking about 10% Abrikesh? It is coming out from the question itself. The question says that on 1st July 20X1, LT Limited issued 10% redeemable preference, redeemable debentures of rupees 50 crore. Now I need to compute the capitalization value 20X2, X3. Again, what is my total expenditure? January 30th June, 31st March 20X2, correct? 31st March 20X2, 30th June 20X2. Okay. Now, what is my date of capitalization? 30th June 20X2 means only for 3 months. Only for 3 months. Correct? So this 5 crore multiplied by 3 by 12. This 20 crore multiplied by 3 by 12. 20 crore multiplied by 3 by 12. 1.875 crore multiplied by 3 by 12. 5 crore multiplied by 0 by 12, because again this amount has been spent on last date. Correct? Sir, why this 1.875 crore is also used for the purpose of weighted average accumulated expenditure? I am computing weighted average accumulated expenditure for this asset, for the construction of this asset. For the construction of this asset. Now you need to tell me this 1.875 crore, what accounting entry I have passed on 31st March 20X2? What accounting entry I have passed? The capital work in progress account debit, CWIP construction account debit, to interest payable account, to interest cost account, to interest payable account, correct? Then interest payable to bank. So 1.875 crore has become a part of the accumulated expenditure, right? Accumulated expenditure. On 31st March 20X2, you have capitalized this borrowing cost. Now this borrowing cost is also become part of the cost of the asset. Correct? So the total weighted average accumulated expenditure is 11.72 crore. 11.72 crore multiplied by 10 gives you the 1.172 crore of capitalization of borrowing cost. So in 20 up to 20X1 March 31st March 20X1, no borrowing cost to be capitalized. 31st March 20X2, 1.875 crore borrowing cost to be capitalized. 31st March 20X3, 1.172 crore borrowing cost to be capitalized. Correct? This was the one of the complex question from the RTP from 31st May 2003. Is that clear? Any question on the borrowing cost standard? So commencement date, concept, suspension date. Are you clear on those aspects? When your borrowing cost will be suspended? Your borrowing cost will be suspended when the active, what active? When the active development of the asset will be interrupted. For example, a construction was going on and the labor went on strike for 5 months. So for those 5 months, the borrowing cost will not be capitalized. The borrowing cost will be charged to P&L. The standard says that. Cessation of borrowing cost. When the borrowing cost should stop from the capitalization, when the asset has become available for use, available for intended use or sale. Right. So friends, I have covered the borrowing cost concepts, right? And I have also covered these two practical questions on the borrowing cost. Let me know if you have any question on Ind AS 23. I am assuming that you guys have already gone through with the video on Ind AS 23 earlier, which was part of the last batch, where This standard was covered in 3 hours. Any question, Abrikesh, Viraj, Rahul? Yeah, any question?
No, sir.
Okay. Any question, Viraj? Rajiv? Okay. If you don't have any question, then I am moving to my third standard, which is a small standard, Ind AS 41 biological asset, which is relates to biological asset, agriculture standard, right? Agriculture standard. So let me share my screen for Ind AS 41. And again, Ind AS 41 I have covered on which date I have covered in on 19th of November, and it was covered in detail in one class. And I am assuming you guys have already went through the video of Ind AS 41 as well. Even the actual date I have not changed. It is 14 December. It is, yes, 14 December, not 19 November. It is 14 December. Yes. What is this agriculture standard? This standard talks about biological asset. Yes, the standard talks about biological asset, right? So it says that, Ind AS 41 covers three aspects. Aspect number one, biological asset. And what is a biological asset? Biological asset is a living animal or plant. Biological asset is a living animal or plant. Correct? So living animal or plant, if it is related to agricultural activity, then it will be covered under Ind AS 41. Living animal, what does it mean? Have you seen the circus? Probably yes, you guys have seen the circus. In circus, you have seen that elephant is playing football, the monkey is riding bicycle, the lion is jumping between the rings of the fire. So these animals are living animal, answer is yes. Whether these animal are biological asset, answer is yes. But whether these animals are used for the agricultural activity, related to the agricultural activity, yeah, answer is no. These animals are not used for agricultural activity. These animals are used for entertaining the audience. Entertaining the audience. Correct? So in this case, these animals will not be covered under Ind AS 41. These will be covered under Ind AS 16. Correct? Sorry?
Sorry, PP, I mean.
Yes, PP. Because it is not related to the agricultural activity, right? So friends, any living animal who is related to agricultural activity will come under this standard. For example, agricultural activity includes your, milking a cow, or let's say, what would I say, poultry farming, chicken farming, fishing, fish breeding. So these activities are covered under agricultural activity. Okay. So biological asset includes living animal and plant as well. When I say plant, if it is a non-bearer plant, there are two kind of plant. One is bearer plant, another one is non-bearer plant. Bearer plant means those plant which bears fruits and vegetables for more than 1 year, like mango, like apple, guava, banana, uh, tea, coffee, rubber. These three provides the agriculture produce for more than 1 year. So these are known as the bearer plant, and bearer plant are covered under Ind AS 16, property, plant and equipment. Non-bearer plant like potato, tomato, cauliflower, radish, flower plant. So these are covered under non-bearer plant, which is covered under biological asset, which is covered under Ind AS 41. So this standard is applicable to biological asset. This standard is applicable to all the agriculture produce up to the point of harvest, at the point of the harvest. For example, mango. is lying on the mango tree. Mango is the agriculture produce, but it will come under Ind AS 41 only when the farmer or the owner is plucking those mangoes. For example, today is 30th May, and today if the farmer or the owner is plucking the mango, in that case, on 30th May, the recognition and measurement of this agriculture produced mangoes will happen on this date. Okay, will happen on this date as per Ind AS 41. Third one is government grant. If a government grant is received in connection to a biological asset or agriculture produce, it will be covered under this Ind AS 41. Otherwise, all the government grant will be covered under a separate standard, which is Ind AS 20, accounting for government grant and disclosure of government assistance. So this was the coverage of this standard, correct? This standard is not covered. This standard is not covered. This standard does not covers land. You are using the land for agricultural activity, but this land is no more a biological asset. This land it does not covered under Ind AS 41. This is covered under either 16 or 40. Bearer plant, as I explained you, mango tree, tea tree, rubber tree, coffee tree, these are the bearer plant and it will be covered under Ind AS 16. But the produce on the bearer plant has to be covered under Ind AS 41. Government grants relating to bearer plant will be covered under Ind AS 20. Intangible asset, for example, there are rich farmers. They are using a lot of know-how, technical know-how, licenses. So these are also subject to Ind AS 38 intangible asset standard. Okay. Right of use asset related to a lease of a land related to agricultural activity. There are some farmers who are doing the agriculture and they have taken the land on a lease basis. So as per Ind AS 116, they are capitalizing right of use asset for that. So that right of use asset will be covered under Ind AS 116, not under Ind AS 41. Correct? So this standard covers biological asset. And for biological asset, this standard cover living animal. For plant, it is bifurcated into bearer plant and non-bearer plant, right? So bearer plant which provide agriculture produce for more than 1 year, covered under Ind AS 16. Non-bearer plant, it only provides within a year, 1 or 2 seasons. It is covered under Ind AS 41. Okay. So this was the scope of this standard and the basic details of this standard. So now we'll discuss the recognition criteria. When a biological asset or agriculture produce is going to be recognized, friends, for recognition of every asset, two conditions must be satisfied. Number one, future economic benefit should be probable. Number two, cost can be measured reliably, right? For any asset in this world, because it is coming from the basic definition of an asset. So future economic benefit should be probable and cost can be measured reliably. But in this standard, this is kind of a, standard which is dealing with a unique kind of activities. So the word fair value is also given. Fair value oblique cost can be measured reliably. Why? You have a mango tree. Of course, mango tree is a bearer plant. It is covered under Ind AS 16. Now you have mangoes which are lying on the mango tree. And every year this mango tree is given 1000 kgs of mangoes. You have plucked around 1000 kg of mango, correct? Is there any cost to these mangoes? I mean to say minuscule cost is there. But is there any cost to these mangoes which you have plucked from the tree? No cost at all. Or even though the cost would be there, it is a very limited cost. You will say that, sir, I have used the manpower and that person has taken 1000 rupees for plucking those mangoes, right? For plucking those mangoes. So it is not the real cost. It is not the actual cost. It is minuscule cost. But what could be the fair value of the mango? Probably 50 rupees per kg. Correct? So probably 50 rupees per kg. The cow has given birth to a calf. Is there any cost to that calf? Yes or no? Yes or no? When I'm saying cost, I'm asking, have we acquired that calf? Have we paid a real cost? I'm not talking about the minuscule cost. Abrikes, Viraj, Rajiv, Rahul, Divya, have we spent any real cost? Answer is no. But whether that calf has a fair value, whether that calf has a market value, the answer is yes. The answer is yes. So friends, that is why the kind of the asset with which the standard is dealing, the standard has given fair value oblique cost can be measured reliably. The last three standard which we have read, 16, 38, 40, no one was talking about fair value can be measured reliably. Everyone was talking about cost can be measured reliably. But here, fair value oblique cost can be measured reliably, right? And in all those three standards, the concept was only, there was two concepts for recognition criteria. Number one, future economic benefit should be probable. Number two, cost can be measured reliably. But in this particular asset, the third concept is also there, which is entity should control the asset. Entity should control the asset. Entity should control the asset. Why it is important? So let me again explain with the help of an example. There was a company and there was a plant. Okay, plant means factory of a company. A street dog was sitting outside the factory of a company. Correct? And the company was giving milk and bread to that dog. Correct? And the dog was sitting outside the gate of the company like a security guard. And the dog was ensuring that no trespasser or no stranger will enter into that company, into the premises of that company. Question number one, whether the company has a future economic benefit from the dog? Answer is yes, in terms of security which the dog is providing. And even your property, plant and equipment standard says that if there is a safety equipment like fire extinguisher, which can only be used when the fire will be there. So these safety equipment, security equipment are also considered as an asset. So from the dog who is sitting outside and who is doing a security, future economic benefit is there? Yes, in terms of security. Whether fair value can be measured reliably? Answer is yes. For every kind of an asset, there is a particular market. So if you go to the veterinary valuer, he will check the breed of the dog and he will get the fair valuation done. Abricase, it can be there. Okay. But whether the entity is controlling that dog, whether the entity is controlling that dog, answer is no. Tomorrow, if municipality when will come to catch these street dogs and take these dogs to the dog shelter, the company cannot stop that. Correct? So the company does not have any control. So if the company does not have any control, whether the company can recognize this dog into the balance sheet, answer is no. Answer is no. The second one is for agriculture produce, let's say. The mangoes which are lying on the mango tree, till the time you are not plucking the mangoes, will you will you recognize the mangoes the agriculture produce in your balance sheet? Answer is no. Why? Number one, till the time these mangoes are on the tree, till the time you are not plucking these mangoes, you are not sure if the mangoes will be destroyed due to a natural calamity, due to some insects, due to some, hit by the insects, due to some natural calamities, due to some birds, right? You are not sure till the time you pluck the mango, you identify the mango, you are not sure whether the mangoes will be usable or will not be usable. And that is why the control is not there till the time it is on the tree. And hence, the agriculture produce is always going to be recognized when the company will pluck, will harvest those agriculture produce, right? So friends, for recognizing a biological asset or agriculture produce, The three condition recognition conditions should be satisfied. Future economic benefits should be probable. Fair value or cost can be measured reliably. And the entity should control the asset. And then the entity should control the asset. Correct? Entity should control the asset. Is that right? Now, after recognition, a measurement criteria is also there. Sir, we understood we have recognized the assets. But sir, how will we measure the asset? How will we measure the asset? Right? So friends, the asset will be measured. The asset will be measured. Biological asset. If I talk about biological asset, there are two kind of measurement of the biological asset. Number one, initial measurement. Number two, subsequent measurement. What is meant by initial measurement? Measurement on the transaction date. What is meant by subsequent measurement? What is meant by subsequent measurement? Measurement on the reporting date. So biological asset has to be initially and subsequently measured on the basis of fair value less cost to sell. On the basis of fair value less cost to sell. Initial measurement will be at fair value less cost to sell. Subsequent measurement will also be at fair value less cost to sell. But what about agriculture produce? What about agriculture produce? The agriculture produce will initially be measured at fair value less cost to sell. Agriculture produced will initially be measured at fair value less cost to sell, but subsequently, it has to be transferred immediately to the inventory. For example, I hope my Excel file is visible. I hope my Excel file is visible.
Yes, sir.
For example, Nestle India Limited. Nestle India Limited has a mango orchard. So this mango tree is a tree which is covered under Ind AS 16, correct? But these mangoes which are lying on the tree, these mangoes are agriculture produced, right? So it is covered under Ind AS 41. For example, on 31st July 2021, let me write 31st July 2023. Latest example. On 31st July 2023, the company has plucked 1000 kgs of mangoes. The company has plucked 1000 kgs of mangoes. Okay. In this case, it is 100 kgs of mangoes. So these mangoes, when the company has harvested 100 kgs of mangoes, these mangoes are measured at fair value less cost to sell. Assuming the market value is 50, cost to sell. If the company would have to sell these mangoes, the company have to incur 5 rupees per kg of cost. So the fair value less cost to sell of these mangoes are 45 rupees. So what is my first accounting entry standard says that since there is no cost, but there is some asset, agriculture produce. So agriculture produce account debit to other income because there is no to bank. There is no bank to other income. Immediately, this company will use this mango for a raw material. The company will manufacture jam, sauces, chutney, pickles, soft drinks. So the company will use this mangoes like a raw material, right? So instant, the next entry will be immediately. This agriculture produce will become inventory. Inventory or raw material account debit 4502. Agriculture produce account debit on 31st July 2023. The first entry was agriculture produce account debit to other income. And it was measured at fair value less cost to sell. But the second entry, immediately it has been transferred to raw material or inventory. Correct. So what would be the subsequent measurement of this agriculture produce? What would be the subsequent measurement? On the reporting date. On the reporting date, it does not have an existence of agriculture produce. On the reporting date, it will have the existence of inventory. So it has to be measured at the time of subsequent measurement as per Ind AS 2. There is nothing called as agriculture produce. So friends, for biological asset, there is an initial measurement as well as subsequent measurement. But for agriculture produce, there is nothing called as a subsequent measurement. Why? Because on the date of initial measurement, it has to be transferred to inventory after getting measured as per Ind AS 41. Is that clear? Is that clear or not clear? Tell me. Is it clear or not clear? Clear? Okay. So friends, this was the measurement criteria for biological asset, and all the gain and losses of initial measurement and subsequent measurement will go to P&L, correct, as a other income. I have one complex or detailed question on Ind AS 41, which I'll discuss. Although I've discussed this question in detail in my last video, in the last batch. Moon Limited prepare financial statement to 31st March each year. On 1st April, the company carried out the following transaction. Purchase a land for rupees 50 lakh. Tell me, is it a Ind AS 41 item or is it a Ind AS 16 item? Whether this land is a biological asset or a PP, it's a PP. So what is the accounting entry? Land account debit to bank account, it will go into the balance sheet. Purchased 200 dairy cows. These cows are biological asset, living animal. The average age of the cow is 2 years for rupees 10 lakh. The company has purchased 200 cows for rupees 10 lakh. What is the cost of per cow? 5,000 rupees the cost of per cow. Correct? The company has received a grant of rupees 1 million towards the acquisition of this cow. This grant was non-refundable. It means there was no condition attaching to the grant. So if the company has received a grant, this grant is going to be other income. Correct? And the company has purchased 200 cows. These cows are the biological asset. For the year ending 31st March 2020x2, the company has incurred following cost. 6 lakh rupees to maintain the condition of the animal, food and protection. It is an expense debited to P&L. 4 lakh rupees as a breeding fee to a local farmer. It is an expense to P&L. After 6 months, on 1st October 20x1, 100 calves were born. 100 calves. These 200 cows has given birth to 100 calves. Again, biological asset, measured at fair value less cost to sell. There were no other changes in the number of animals during the year ended on 31st March 20x2. So there are 200 cows which was purchased on 1st April 20x1, and there was 100 calves which were born on 1st October 20x1, right? Otherwise, there were no other animal. There are total 300 animal on 31st March 20x2. As of 31st March 20x2, Moon Limited had 3,000 liter of unsold milk in inventory. When this milk was milked, it was agriculture produced and then it was transferred to inventory. So on 31st March, this milk was coming as an inventory. The milk was sold shortly after the year end at market prices. Correct? Is the question clear? On the first page, is the question clear or not clear? Question is clear or not clear so far? Clear. Viraj, is it clear? Any doubt from the question? Any doubt? Okay. Fair. Now there is one chart which is given. In the chart, the values are given. The fair value less cost to sell is given. And the fair value less cost to sell for land is also given. Is this fair value less cost to sell of land is relevant? Yes or no? Not from Ind AS 41 perspective. And this land is Ind AS 16, even not Ind AS 16 perspective. But yes, from the impairment perspective, it is relevant. Let's say on 31st March 2002, if the fair value less cost to sell has become only 40 lakhs, although we have purchased at 50 lakhs, it means there is an impairment. So it is important from Ind AS 36 perspective, right? It is not important from Ind AS 16 or 41 perspective, probably. So in this case, the land value was 50 lakh on 1st April, 60 lakh on 1st October, on the balance sheet date 70 lakhs. Not relevant. Correct? Okay. Now, newborn calves per calf. On 1st April, the newborn calf fair value was 1 lakh. Is it relevant? No. The calf was born on 1st October 2001, right? So when the calves were born, the fair value less cost to sell for the calf was 1100. Is it relevant? The calves were born on 1st October 20x1. So when the calves were born, will you recognize the asset? Yes, you will recognize the biological asset. At what value? Fair value less cost to sell. What is the quantity of this calf? कितने calves हैं? 100. What is the fair value less cost to sell? 1100. What is the total value? 1100. 100 means 1,10,000. What is the accounting entry? What is the accounting entry at the time of initial recognition and measurement? What is the accounting entry?
Biological asset debit.
Biological asset calf account debit to other income. To other income,
Yeah.
right? Standard says that to other income. So means one leg will go to balance sheet, one leg will go to P&L, right? On initial measurement. And in this question, there is a value which is given for 6-month-old calf. 6-month-old calf. Whether this value is relevant? Yes, this value is relevant. Why? Because when we'll come on 31st March, this newborn calf will become on 31st March 2002. This newborn calf will become 6 months old calf. And since when the age is growing on, the fair value will also be increased. So on the reporting date, on the subsequent measurement date, you have to again measure your biological asset at fair value less cost to sell. So now from 1100 it will become 1300. So what to do now? The value, the price has been increased by 200. So again, biological asset calf account debit to other income, being the changes in fair valuation has been recognized for the biological asset calves. 200 multiplied by 100. What is the amount? 20,000. Is that accounting entry clear or not clear? Clear? Okay. Now the value of 2-year-old cow is also given. 2-year-old cow is also given. What is the relevance for the fair valuation of 2-year-old cow? The average age when these 200 cows were purchased, the average age was 2 years. The average age was 2 years, correct? The average age was 2 years. Whether fair value less is relevant. So we have purchased these cows at 5,000 rupees, and at the date of purchase, the fair value less cost to sell is also 5,000. Now we have to remeasure these cows on the reporting date, which is 31st March. 31st March 20x2. On 31st March 20x2, this cow has become 3 years old, right or wrong? And that is why 3-year-old cow's fair value is also given. On 31st March 20x2, the cow has become 3 years old, because when we purchased on 1st April, this cow was 2 years old. We have purchased at 5,000 rupees. So difference between 5,000 to 5,500, 500 rupees. This has to be recognized as biological asset cows account debit, 200 multiplied by 500 to other income, being fair value changes recognized in biological asset and transferred to other income. There was an inventory of milk also, and the closing fair value of the milk is given. NRV is given, which is 24. You are required to prepare the extract from the balance sheet and P&L that would be reflected in the financial statement of the entity for year ended 31st March 20x2. Is the question clear or not clear? Please tell me. Viraj, Rahul, Divya, Abrikesh, Rajiv, is the question clear? Now we will solve this question. We will solve this question, right? In this question, first of all, we have purchased the land, right? We have purchased the land. The accounting entry for purchase of land, land account debit to bank account. So land will come into the property, plant, and equipment. This is a balance sheet extract. This land will come as a property, plant, and equipment 5 lakh, assuming cost. There is no penal impact of this land. Correct. Now biological asset will also come in the balance sheet. On 1st October 2001, calves were born. Biological asset calf account debit to other income. The value was 1100. 1100 multiplied by 100, 1 lakh 10,000. So 1 lakh 10,000, 1 lakh 10,000 will go to the PNL on birth, on subsequent measurement, on subsequent measure. But 1 lakh 10,000, and on subsequent measurement, this 1100 value becomes 1300. Biological asset account debit to other income 30,000. So 1 lakh 10,000 plus 20,000. 1 lakh 30,000 will go to the PNL as the income from newborn calf. And this newborn calf, which is now 6 months old, this will go to the balance sheet as a biological asset. Calf 6 months old, 1 lakh 30. Correct. Now value of the cow was 5,000. Number of cow 200. Now the closing value is 5,500. When the cow was initially purchased, biological asset cow account debit to bank account 10 lakh rupees. But this 5,000 rupees cow fair value has been increased to 5,500. So 500 multiplied by 200. Biological asset cow account debit to other income 1 lakh. 1 lakh will go to fair value changes in cow in the P&L. Correct. And the cow will go to the balance sheet 10 lakh plus 1 lakh, 11 lakh. Cow 3 years old. Correct. So we have taken income from newborn calf, value cow. There was a government grant of 10 lakh also, which was an unconditional grant. Entry bank account debit to government grant, other income account. So this 10 lakh will come into the P&L as the income. Correct. There was an inventory of milk also. And what was the inventory? The fair value was how much? 24 rupees. The milk was 3,000 liters. Agriculture produced account debit to other income, 72,000 when the milking is there. And the next entry, inventory account debit to agriculture produced 72,000. This 72,000 will come under income. Agriculture produced milk. And the second line item as an inventory in the balance sheet, milk 72,000. You remember two expenses were also given. Maintenance expenses and breeding fees. 6 lakh and 4 lakh. So this 10 lakh will charge to PNL. Your profit is 3 lakh 2,000. Your balance sheet is 63 lakh 2,000. This is how this question was solved. Correct. So friends, do let me know if you have any question on biological asset. Do let me know if you have any question on biological asset.
Sir, Rakesh.
Yeah, Abhrakesh.
Sir, in this example, where we have considered the assets, only asset sides. It's not required to be, mention any liability side. So we need not to tally the total. Last example, cow.
Yes, the requirement of the question is prepare extracts from the balance sheet and statement of P&L.
Okay.
Nothing called as a liability was given.
Yeah. Okay. Thank you.
Any other question? Any other question on Ind AS 105, Ind AS 23, or Ind AS 41?
Hello.
Yeah.
Sir, in case of the trees, bearing bearer assets. For say example, mango. But before the harvesting, the cost. By any chance, cost is to be included in that tree as a under PP. Cost of tree we will calculate. But
no.
What about?
Yeah. So I understood your question. So let me explain it. Mango tree is a bearer plant. So the cost of mango tree, when you are planting a mango tree, let's say you have purchased a mango tree and you have put some fertilizer so that this mango tree will get, this mango plant will become a tree. Okay.
Yeah.
So till the time it is established, it is well, recognized as a mango tree, right?
Yeah.
You are capitalizing the mango tree as per Ind AS 16 principle,
Yes. Yes.
direct attributable cost, etc., etc. Right. Every year you are putting some fertilizer. You have some, what would I say? A gardener,
Yes.
right? You're putting some medicine for saving from
Yeah.
the insects. Okay,
Yeah.
so you are putting water on that
Yes.
plant so that fruits will be there.
Yes.
So that the regular maintenance expenses will be debited to P&L always.
Yes. Yes.
Okay, P&L,
Revenue. Yes.
revenue expense. Now there are mangoes on the tree,
Yeah.
so you're not doing any accounting for those mangoes. You're not doing. But whenever you're harvesting those mangoes, at that point of time, you are doing the accounting. Since you have already debited all the expense for maintenance of the tree or those mangoes into the P&L. So whenever you are getting mangoes or getting an agriculture produce, so
Okay.
on the date of harvest, you are recognizing that agriculture produce as an asset and other income on the basis of fair value less cost to sale.
Okay. Okay, sir. Got it. Thank you.
Any other question, friends? If there is no other question, I would be happy to conclude the session. It's 9:57 now. So we are just 3 months left, 3 minutes left. Any question? Let me see on the query box. There is no question query link left for answer. Thank you, friends. If there is no question, I would be happy to conclude the session. Thank you so much.
Thank you, sir.
You have any
Sure,
question?
sure.
Any question, Abrikesh?
No, sir. I
Okay.
just thank. Yeah.
Okay. Okay. Thank you so much. Just have a good day. Bye bye. Take care. Thank you so much. Session is over. Yeah.